There will be substantial calculations for these questions. After understanding the calculations, for examination purposes, you must be able to translate your understanding of these calculations into discussions and advise how this affects the financial performance and financial position of the entity. For examination purposes, discussion is more important, but before you can discuss, you must understand the requirements by going through the calculations. You are required to determine how AAL should account for the above financial assets in the financial statement from 1st Jan 2015 to 31st December 2016, 2 year. The financial year end is 31st December 2016. Part A. The question mentioned that AAL acquired a debt instrument issued by BBL on 1st Jan 2015. At its fair value of 57092, the cost, the debt instrument is repayable on 31st December 2018, 4 years from the date of investment, at par value of 50. This is the initial amount, this is the redemption amount. If the initial amount and the redemption amount is different, we must adjust the initial amount to redemption amount, then there should be some amortized cost adjustment. The debt instrument pay a nominal interest rate of 9%, the coupon rate, or call this as nominal rate, or sometimes we call this as contractual rate. Effectively, the investment have an interest rate of 5%, effective interest rate. If the initial amount and the redemption amount is different, the coupon rate and the effective interest rate will not be the same. At the date of purchase, 1st Jan 2015, the management of AAL estimated the risk of default in the next 12 months was 1%. After the 12 months, the maturity date was 3%. The expected cash shortfall, the amount of cash they expect not to receive that if there's a default, was 30%. Assuming that we meet the business model test and the cash flow test, this is the financial assets at amortized cost. You are given the answer over here. You may want to read the answer yourself, but can I do it together with you? Financial assets at amortized cost. Whenever you talk amortized cost, you must consider the cash flow. On 1st Jan 2015, this is the day that they acquired the investment, paid 57092. And this investment have the cash flow of 4 years, 31st December 15, 31st December 16, 31st December 17, and 31st December 18. This investment produced a cash flow based on the contractual rate or effective interest rate, 9%, multiplied by $50,000. When we talk about cash flow, you have to look at the contract. Contractually, we're going to receive 9%, 9%, 9%, 9% over the 4 years. At the end of the year 4, we're going to take back the 50,000. 4,005, 4,005, 4,005, 4,005 plus 50. This is the contractual cash flow over the 4 years. We have to discount this to a present value of 57092. So what's the interest rate to discount 4,005, 4,005, 4,005 and 54,500 to a present value of 57092? The question says it's equals to 5%. This 5% is the effective interest rate. Discount based on 5%, 5% to the power of 2, 5% to the power of 3, 5% to the power of 4. If we add out this figure, it's equals to 57092. Now we'll talk about financial assets at amortized cost together with impairment allowance. This is the financial assets at amortized cost, impairment allowance. We need to know what's the impairment allowance at year 0. On the day we acquire this investment, immediately you're taking some credit risk. If you are taking the credit risk, you must account for the expected credit losses. On the day they acquire this investment, the expected cash flow shortfall each year is 30%. In the event there's a default, they are not able to receive 30% of the cash. This is the cash contractually. In the event there's a default, how much they cannot receive? 30%. Take this amount multiplied by 30% is equals to 1350, 1350, 1350, and 54,500 multiplied by 30% is equals to 16350. In the event there's a default, this is the amount that you cannot collect. So we call this a shortfall. We have to calculate the present value of this, discount this by the effective interest rate of 5%, 5% to the power of 2, 5% to the power of 3, 5% to the power of 4. Basically, this amount is the amount of this 30%. It's the amount of this 30%. The present value of this expected cash shortfall is equals to 17127. We call this as expected credit losses, ECL. In the event there's a default, this is the loss. But how likely for this loss to take place for the next 12 months? On the day we acquire this investment, for this to take place is 1% chance. After the 12 months, the chance for this loss is 3%, which means over the next 4 years, the chance for this loss is 4%. Based on 17127 multiplied 1% is equals to 171. We call this as 12 months expected credit losses. 17127 multiplied 4% is equals to 685. This is over the remaining 4 years, over the remaining lifetime. We call this as lifetime expected credit losses. To calculate this amount, do we use 171 or 685? In accordance to IFRS 9, at the date of purchase, use the 12 months expected credit losses, 171. Net amount appear in the balance sheet is equals to 56921. This is the amount that you must account for at day 1. Look at the entry here. At the date of purchase, 1st Jan 2015, debit assets, credit cash, 57092. Immediately, we must account for impairment loss allowance, 171. Initially, it must be based on 12 months expected credit losses. Initially, we have to apply the 12 months expected credit losses. After a year, now we'll get year end, 31st December 2015. If you hold this investment for 4 years, effectively we earn 5%. Every year you must account for interest based on 5%. 57092 multiplied 5%. The interest income recognized in P&L, 2855 to profit and loss. Every year we receive 4,005. The 4,005 partly is received for interest income, partly is for repayment of principal. If it's received for repayment of principal, we must reduce the principal. After a year, principal should be lesser. Then look at double entry. This will be a double entry at 31st December 2015. Debit cash. This cash is based on the coupon rate of 9% multiplied by $50,000. Interest income is based on the effective interest rate multiplied by the financial assets. The difference is the amortized cost adjustment. In this case, the difference is a repayment of principal. If it's repayment of principal, reduce the principal. After doing this, our financial assets will be equals to 57092 plus 2588 minus 4005 will equals to 55447. Next item we look at is the impairment allowance. We have to calculate this amount again. We have to go through the entire process again. Contractual cash flow. How much of these that we cannot receive for the next 3 years? Expected cash shortfall. On 31st December 2015, the management of AL estimate the risk of default over the next 12 months will be 5%. After 12 months, it's another 9% chance. If there's a default, this is the amount that we cannot receive. It's equals to 40%. We call this as expected cash shortfall. How much of this we cannot receive if there's a default? It's equals to 40%. 40% of 4,005, 4,005, 54,500. This is the expected amount that we may not be able to receive in the event there's a default. 1,008, 1,008, 21,800. We have to calculate what is the present value. Whenever we talk about present value, we must discount based on the effective interest rate of 5%. This amount is going to receive in 1 year's time from now. 2 years' time, this is 3 years' time. 1.05 to the power 1, 1.05 to the power of 2, 1.05 to the power of 3. The present value of the expected cash shortfall is equals to 22,179. This is the ECL, expected credit losses. In the event there's a default, these are the losses that I expect to incur. But we have to ask ourselves, what's the chance for this loss to take place for the next 12 months? The chance for this to take place for the next 12 months is equals to 5%. What's the chance for this to take place over the remaining 3 years? 5% plus 9% is equals to 14% chance. 22,179 multiplied 5% chance is equals to 1109. We call this as 12 months expected credit losses. 22,179 multiplied by 14% chance is equals to 3105. We call this as lifetime expected credit losses. Which one do we take? Do we take the 12 months or lifetime? Depending on these assets, is it stage 1, stage 2 or stage 3? The risk of the expected default for the next 12 months is 5%. After 12 months is equal to 9%. Total is equals to 14%. As compared to initially is 4%. This 14% chance is not considered as low. If it's not low, have this increased significantly? Answer is yes. But is there any evidence of impairment? So far there's no evidence of impairment. Initially it's 4%. At the year it's 14%. We cannot say the 14% is considered as low. It's not low. If it's not low, have the credit risk increased significantly? Yes. From 4% jump to 14% is considered a significant increase. If there's no objective evidence impairment, no. Then we call this a stage 2 assets. For this question, it's a stage 2 assets. For stage 2 assets, we have to use the lifetime expected credit losses. Stage 2 assets. This amount will be used to account for this impairment allowance, 3105. The net amount will be equals to 55447 minus 3105 is equals to 52342. This will be the balance at the end of the first year. We have to increase from impairment allowance of 171 to 3105 is equals to 2934. This will be adjustment to profit and loss. Debit impairment loss to profit and loss. Credit impairment allowance account. This will be adjustment entry. The impairment allowance adjustment for 31st December 2015 will be 2934. Debit impairment loss P&L credit impairment allowance account. This amount is the adjustment between the carry forwards minus the brought forwards. This carry forwards is based on the lifetime expected credit losses. BBL failed to pay the 9% interest on 31st December, and there's evidence that BBL is having significant financial difficulty. These are evidence of impairment, the stage 3 assets. After considering the probability of default occurring over the remaining life of the debts is 50%, that means remaining 2 years, AL expected to recover only 33075 on 31st December 2018. Now we look at 2016, year end. The amount of income recognized in P&L is based on the gross amount. You have to take the gross amount multiplied by 5%. This is a stage 2 assets, last is a stage 1 assets. If it's a stage 1 assets, stage 2 assets, take the gross amount to calculate interest income. 55447 multiplied by 5%. Interest income for the second year should be equals to 2772. This is the amount that we're supposed to recognize in profit and loss. We're supposed to receive this amount, but we did not receive because BBL have missed the payment. This is equals to 0. After the second year, financial assets will be equals to 55447 minus 2772 is equals to 58219. Now we have to calculate this amount. We have to consider the remaining cash flow. How much of this that we cannot collect? For the next 2 years, they did not give us this amount. After considering the probability of 50%, they think that they can collect is equals to 33,075, the amount that they're expected to recover after considering the 50% probability. Now we have to calculate what's the present value of this. 33,075 over 1.05 to the power of 2 equals to 30,000. This asset is only at 30,000. Now it's equal to 58,219. You must adjust to 30. There should be an impairment allowance cumulatively of 28,219. This is the year-end figure. We have to adjust from 3105 to 28,219. Is equals to 25,114. This will be the adjustment entry. Debit impairment loss, credit allowance. This is the entry that we discussed earlier on, 2514. Stage 1 and Stage 2 when calculate interest income is based on the gross amount. If it's a Stage 3 assets, we must calculate interest based on the net amount, 5%. It means from now onwards, interest should be 5% of the net amount for Stage 3 assets. The interest income for the year ending 2017 should be based on the amortized cost amount, the net amount, after the impairment allowance. There are 3 stages of financial assets, Stage 1, Stage 2, and Stage 3. For Stage 1, the impairment allowance is based on the 12 months expected credit losses. For Stage 2 and Stage 3, the impairment allowance is based on the lifetime expected credit losses. Although they call this as lifetime, the amount will not be the same. Because for Stage 3 assets, the lifetime expected credit losses will be higher than the Stage 2 lifetime expected credit losses. And what's the difference between Stage 2 and Stage 3? Both are based on lifetime expected credit losses. For Stage 2, the interest income is based on gross. For Stage 3, the interest income is based on net. Now we look at Part B. AL have trade receivable of $10,000 at 31st December 2016. The trade receivable are categorized by the common risk characteristics. All trade receivable have a maturity of less than a year. This is a trade receivable without significant financing component. If it's without significant financing components, we have to apply the simplified approach for impairment model. For trade receivable without significant financing components, we have to use the simplified approach. We only use the lifetime expected credit losses. You do not need to monitor whether the risk is high or low, whether the risk have increased significantly or not. We have to apply the lifetime expected credit losses. Out of this $10,000, $400 is considered as unrecoverable, or we call this as bad debt. If it's bad debt, you must remove from your ledger accounts, equals to a balance of $9,006. And to determine the expected credit losses, we have to use the simplified approach, that means apply the lifetime expected credit losses. Normally for trade receivable, we can apply the provision metric to account for the impairment allowance for trade receivable. In the past, we call this as doubtful debt allowance. We are given the breakdown of the 9,006. Out of this 9,006, 5,002 is not overdue. Even there's no overdue, there's still a risk of default, but the risk normally is lower. But when it's overdue by 1 to 30 days, between 31 to 60 days, the longer they get overdue, the higher the credit risk. This should be reflected in the lifetime expected credit loss ratio. 0.6% multiplied 5,002, 1.8% multiplied 2,001, 4% multiplied 1,005, 8% multiplied 500, 15% multiplied 300. Take the total. Refer to a suggested answer. Trade receivable that does not contain financing component, the impairment allowance should be based on the lifetime expected credit losses. Simplified impairment model. In other words, we do not need to monitor whether the risk is low risk, high risk, have increased significantly. Most companies will apply the provision metric to account for the impairment allowance for trade receivable. This is what we have, equals to 214. 214 is the balance at the year end, 31st December 2016. If the brought forward is equal to 0, carry forward is equals to 214, so we must increase from 0 to 214 by 214. Doubtful debt adjustment. We have to debit impairment loss or doubtful debt loss and credit impairment allowance or doubtful debt allowance, 214. In our statement of financial positions, our trade receivable will be at 9,006 minus the doubtful debt allowance or impairment allowance. The net amount will be 9,386. We can call this as impairment allowance or we can call this as doubtful debts allowance. Part C, AAL acquire a debt instrument on 1st Jan 2015. The debt instrument have a fair value of 40,000. On the initial recognition is measured at fair value through OCI. This is the financial assets at fair value through OCI. Debt instrument means you pass the business model test and pass the cash flow test. This asset is held within a business model to collect cash and for sales. That's why it must be a fair value through OCI. The instrument have a contractual term of 5 years. Both the nominal interest and effective interest is equal to 8%. It means that there's no amortized cost adjustment. Pay 40 to buy the assets. After 5 years, you will take back the 40. The effective interest rate is equal to coupon rate. So there's no amortized cost adjustment. Because it's measured at fair value, even there's no amortized cost adjustment, but there's a fair value adjustment. The fair value adjustment will be recognized in OCI. The plus minus of fair value is due to changes in the market interest rate. 1st Jan 2015, at the date of purchase, the expected credit losses were therefore measured at $30. Stage 1 assets. When it comes to year end, 31st December 2015, the fair value of the debt instrument had declined to 39,200 as a result of changes in the market interest rate. Initially it's equals to 40, now it's 39,200. There's a minus of $800. Minus $800, there are two components. One component is the impairment loss. The other component is the plus minus in fair value. The impairment loss must be recognized in P&L. The plus minus in value recognized in OCI. At the year end, based on the 12 months expected credit losses, it's still the stage 1 assets. The expected credit losses were therefore 90 because the question mentioned that there's no significant increase in the credit risk at the end. They sold the investment for $39,200 on 1st Jan 2016. C. A financial assets at fair value through OCI with the impairment adjustment. Debt assets that meet the cash flow test and the business model test, held to collect cash and for sales. 1st Jan 2015, this is the date they purchased. Financial assets is equals to 40,000. On the day you purchase a debt instrument, to a certain extent we are taking some credit risk, must account for the expected credit losses. The impairment adjustment that we set aside should be equals to 30 as per question. This $30 impairment allowance should be recognized in profit and loss. That gives us 39970. But hang on, this is an assets measured at fair value. This is not fair value. This is the fair value. We must put back to the fair value is equal to 40. We have to put back the 30. This is adjustment that must go to OCI. At the first day of the investment, financial assets must measure fair value. First is to consider the impairment adjustment to P&L. For impairment, normally we debit profit and loss, $30. We'll credit the allowance account. But if you credit allowance account, you reduce the carrying value of the assets, but this is not right. The carrying value assets must be equal to fair value. Instead of credit impairment allowance account, for financial asset fair value to OCI, we credit to OCI. This is the amortized cost initially, and also equals to fair value initially. When it comes to year end, 31st December 2015, effective interest rate and the coupon rate is the same. Take this multiplied by 8%. 40 multiplied by 8% is equal to 3,002. But we also receive 3,002 cash. Amortized cost should remain the same, 40,000 amortized cost. After that, we must account for the impairment allowance. Given to us, the question says 90. We must adjust from 30 to 90, increase by 60, the impairment adjustment, recognized in P&L. Debit profit and loss, credit OCI. Adjust again, OCI is equals to 60. When it comes to year end, 40,000 minus 90 equals to 39910. At the year end, the assets fair value should only be equal to 39,200. We must adjust 39,910 to 39,200. There's a minus of 710. How do we achieve this amount? Minus 710 from a positive 90 to a negative 710 minus 800. Debit OCI, credit financial assets, 800. Now look at suggested answer. Part C. The management of debt financial assets that classify as fair value OCI is a combination of both amortized cost adjustment and fair value adjustment. Normally for debt assets at fair value through OCI, the amortized cost adjustment will go to P&L. The fair value adjustment will go to OCI. And we must account for impairment allowance. Because such assets are measured in the statement of financial position and fair value, the expected credit losses recognized under IFRS 9 do not reduce the carrying amount. The carrying amount must be at fair value. In this case, we must credit OCI. At the date of purchase, debit assets credit cash, 40,000. Immediately, you must account for impairment adjustment. Debit impairment loss to P&L, credit OCI. If it's a financial assets at amortized cost, we credit impairment allowance account. But because this is a financial assets at fair value through OCI, the impairment adjustment, we cannot credit the assets. So in this case, we must credit OCI. For the year, we receive 3,002. This 3,002 is based on the coupon rate multiplied par value is equals to the effective interest rate multiplied by the financial assets. In this case, par value is equals to 40, equal to 40. If these two are the same, then the coupon effective interest rate will be the same. We must account for impairment adjustment, $60, debit impairment loss to P&L, credit OCI. Then after that, we must account for the change in the fair value of the financial asset fair value OCI to OCI. This is an entry we discussed earlier. Over here. Statement of profit and loss and other comprehensive income for 31st December 2015. In the profit and loss, there should be an interest income of 3,002. At the same time, we must account for impairment loss, the expected credit loss. 30 plus 60 is equals to 90. In the OCI, the impairment is the 30 plus 60, this amount. At the same time, there's a fair value loss, $800. The net amount of this is equals to 710. This amount is equals to 90. In total, is equals to 800. The financial assets initially, the cost is equals to 40. Now the fair value is equals to 39,200. This 39,200 minus 40 is equals to a loss of 800. Partly is impairment loss, partly is a change in fair value. When we prepare the statement of profit and loss and other comprehensive income for 2016, in the profit and loss, we have a $710 loss. This loss is a reclassification from OCI to P&L. This is a reclassification from OCI to P&L when the asset is disposed of. Must pass entry to transfer from OCI back to P&L. Look at the suggested answer. The debt assets was derecognized on 1st Jan 2016. The losses accumulated in other comprehensive income should be reclassified to P&L. Debit cash, 39200, credit assets, 39200. And we must reclassify it from OCI back to P&L when the asset is sold, 710. That's all for this question. We discussed three issues: management, reclassification, and impairment. The last issue for financial assets will be derecognitions. When do we remove the financial assets from our balance sheets? We only remove the financial assets when we meet the criteria. In accordance to FRS 9, we only derecognize financial assets if one of these apply. 1. When the right to cash flow expire, or number 2, when there's a transfer, substantially or risk and real ownership. Number 3, neither transfer nor retain substantial risk and real ownership, but the company do not have control. If any of these apply, then you must derecognize. If the answer is yes, we derecognize. For example, we debit cash, we sold the assets for 60, we credit the financial assets for 58. There's a $2 difference. This $2 difference is a gain or loss in P&L. In this case, it's a gain. When derecognize. If we do not derecognize, meaning is none of these three apply. If none of these three apply, you receive cash of $60. You cannot credit financial assets. Why? Because you do not meet the criteria. The $60 normally we treat this as a financial liability if you cannot derecognize the financial assets. Refer to the notes in detail. Please refer to page 526. Derecognitions of financial assets. Financial assets derecognize only if one of the three apply. Number 1. Has the right to the cash flow for financial assets expired? If the answer is yes, we derecognize. For example, customer owes us $50. When customer paid the $50, we do not have a right to collect another $50. After collecting the $50 from customer, the rights to collect $50 expired. We must derecognize the trade receivable of $50. Or when we have investment in share options have an expiry date. At the expiry date, we decided to exercise or decide not to exercise, the options expired. If the option expired, option assets must be derecognized. If the answer is no, number 2, has the entity transferred the right to receive cash from financial assets? Take for example, we sold the assets to someone else is going to collect the cash. If the answer is yes, then number 4, has the entity transferred substantially all risk and real ownership? From this moment onwards, when the value of the share go up or down, who is the one that going to benefit or suffer most? If the buyer is the one that benefit or suffer most, that means the seller transferred the buyer substantially all risk and real ownership, then the seller should derecognize the financial asset. But if at this moment, when the value of the share go up or down, the seller still the one that benefit or suffer the most, then we say no, he have not transferred substantially all risk and real ownership. Then number 5, has the seller retained substantial risk and real ownership? Normally, if you have not transferred, normally you have retained. You have retained, meaning is that we do not derecognize the financial assets. There be circumstances, but it's not common exam, whereby there's not transfer, but you have not retained. That means neither transfer nor retain. We have to consider the last factors. Has the entity still have control? If the entity still have control, then we cannot derecognize. If the entity do not have control, we derecognize. You can see from here, when do you derecognize financial assets? You derecognize financial assets when the right to cash flow expire, or when the entity have transferred substantially all risk and real ownership, or when neither there's transfer nor retain substantial risk and real ownership, but the entity do not have control. When you need to derecognize, what should we need to do? For example, we debit cash, $60, credit financial assets is equal to $58. The difference of $2 will be a debit credit to P&L. In this case, the credit to P&L. Recognize any differences. In this case, it's the $2 in profit and loss. If you cannot derecognize, we have to debit cash, $60, assuming that the company retains substantially all risk and real ownership. We cannot credit financial assets. The entity retains substantially all risk and real ownership. This $60 should be credited as a financial liability. Please refer to example 3. The entity received $40 for full redemption of loan assets. Debit cash, $40. Credit financial assets, $40. When we receive $40 for the payment of $40 of loan assets, the right to cash flow expired. If the right to cash flow expired, then we have to derecognize. Second, an unconditional sales of the loan assets for $60 with a carrying value of $50. Debit cash, $60. Credit financial assets, loan assets, $50. The different $10 is considered as a gain in P&L. These are unconditional sales, meaning from this moment onwards, when the value of the share go up or down, the seller is no longer concerned. The buyer is the one that benefit or suffer from this moment onwards. There's a transfer of substantial risk and real ownership. We should derecognize. The first two, we say that it should derecognize. Number 3, the sales of share investment of 60 for 68. This 60 is the carrying value, the 68 is the proceeds, with an options to buy back the share investment at fair value at the time of repurchase. We sell the assets with a rights to buy back, but the rights to buy back is buy back at fair value. It means in 1 year's time, if I buy back, if the share price equals to $100, I have to pay $100 to buy back from the buyer. If I don't buy back from buyer, I can buy from anyone. From now onwards, when the value of the share go up or down, who is the one that benefit or suffer? Is the buyer. Because if I buy back from buyer $100 in a year's time, the buyer will make a gain. If I buy back $50 from buyer in 1 year's time, the buyer will be the one that suffer the loss. From this moment onwards, when the value of the share go up or down, buyer is the one that benefit or suffer. So in this case, we should derecognize. Debit cash, 68. Credit financial assets, 60. The $8 should be recognized as a gain or loss in P&L. We look at the last scenario. A sales of share investment of 70 carrying value for 60 with an obligation to buy back at 65 after 6 months. Number 3 and number 4 are different. Number 3 is the entity have rights to buy back at fair value. Number 4 is that the company have an obligation to buy back at a fixed price. From now to 6 months time, when the value of the share go up or down, the buyer will definitely earn $5 because you pay me 60, 6 months time I pay back 65. You as the buyer, you will make a gain of $5 regardless of the movement in share price. I'm the seller, I'm still subject to the movement in share price. When the share price drop, I suffer. When share price increase, I benefit. When you pay me $60 and taking back 65, you as a buyer, I'm not worried about the changes in value of the share because you'll be earning the $5 from me after 6 months. Me as a seller, still concerned about the movement in share price. That means I've not transferred substantially all risk and real ownership. I retain substantial risk and real ownership. So in this case, the seller, me, cannot derecognize. Debit cash, $60. Can I credit the financial assets, $70? The answer is no. Because this is not a sales transaction. In substance, this is a loan transactions. Because I receive 60 from you now, after 6 months, I have an obligation to pay back 65. The extra $5 in substance is an interest for the 6-month period. In this case, I must credit a financial liability because there's no transfer of substantial risk and real ownership. In fact, there's a retain of substantial risk and real ownership. So I cannot derecognize. We've covered financial assets. Financial assets, there are 4 issues. Measurement, which is the most important issue. Reclassification is the least important. Impairment of assets and derecognition assets. We come to the end of these sessions on financial assets under FRS 9.